Which Russell 2000 ETF is best for retirement? Boy, I get this all the time. People asking me, seeing comments down below, leaving different remarks. And they always come back and say weekly is better than monthly, and this one's better than that one. And I really wanted to do a complete dive into these two funds. Hey, everybody, welcome back to the channel. I'm Doug, the retirement guy. And this is one that's come up on my plate numerous times from different people. And it's always the same two funds, and I get them confused at times. So I know this is going to confuse a few people. But IWMY from Defiance is a weekly paying Russell 2000 ETF. Then we have NEOS's IWMI, the monthly income payer. And at first, on the surface, it does look like a weekly would definitely be a lot better opportunity, especially in a Russell package. So we're going to break this down today. We're going to show which one really can produce what they say, what they do, and how things work. So before we dive into this one, grab your mug, fill it with your favorite beverage, and let's get into the deep comparison between Defiance and NEOS Russell 2000s. Hey, before we go any farther, we do have to do an important disclaimer. The content for this is for educational and entertainment purposes only. This is not financial advice. This is presented by myself. I'm not a financial advisor. If you need financial help, always contact a financial advisor. And past performances do not guarantee future results. Guys, if you don't have your own mug, hey, I'm not going to be here in an advertisement, but this helps support the channel. And with the support you guys have done, boy, it's really helped us out tremendously. The mugs have flown off the shelf. Thank you, thank you, thank you so much. If you haven't gotten them, it's real easy to do. QR code, link down below at the bottom. We appreciate your support. We do this because we don't do advertising. We don't accept any outside influence. We stay unbiased in this whole process. So let's talk about Defiance. IWMY is that weekly pay, and they advertise and promote a 30% yield, which is huge. And I think this is the one we get a lot of people talking to us and saying, hey, I can get 30% over here. Even if I lose a little bit in the NAV, I'm still getting a good 30 points, and I'm getting it weekly. And then NEOS, IWMI is that monthly payer, and they average about a 14% yield. So they pay, middle month, and it's just one of the gambles that we take between the two. So here's the thing I've always said. The golden rule that I've invested by, I live by, is distribution rate is not total return. That is not the serious number. Okay? Yield is a mathematical number. And I'll explain to you how this works. Total return actually tells you what's actually happening inside a fund if you understand how to read. So that distribution rate is just a highlighted cash target. It's not automatically investment income, profit, or guaranteed as wealth prevention. So you put the number out there, and why I say it's a math number is the math number changes. If the price of the shares go up today, that yield's going to come down. If the price of the shares go down, the yield will go up, and that yield changes daily. Almost literally by the minute, it can change. While total return looks at a bigger picture and a bigger package and says, hey guys, it's the ultimate scorecard. It includes the NAV movement plus the reinvestment of distributions. If calculated that way, it reveals what's truly happening to your money. Now, the Russell 2000 small cap has had a great growth opportunities. The potential growth when the interest rates fall is huge, improving lending conditions for small firms, and it's an economical accelerator moving forward. Now, it's some inherited risks is there is a high volatility that creates premiums and added downside pressure. Now, the high sensitivity to the borrowing costs makes small caps move right, left, or indifferent, and typically less stable earnings than those old large caps. Well, it's all the risk and rewards. Is the risk that you take is going to give you higher rewards in the Russell because as the markets change, interest rates go down, they can buy more. The small companies will invest more because they're trying to get to the big boy account. So let's take a look at these funds. And we're going to start with the Defiance. At a glance, the weekly high targeted strategy. They have over $96 million in net assets. Okay. The expense ratio, a little higher, but right in line with most weeklies at 1.05 total gross expenditure. Distributions, as I said, it's weekly. It's at aggressive cash targeting. Now, back in December 17th of 2025, okay, a significant strategy transformation. The fund implemented a material change to its name, investment objective, and principal strategy. So the current performance reflects only the operation of the new model. Okay, so I wanted to show you what the fund's actually doing today, not what it's done long term. So we'll see a lot of stuff about year to date that we want to talk about. So new name, new objective, new strategy. And you got to ask yourself, why did you change all this? Because Defiance was moving more and more towards the weekly strategies, moving more and more towards weekly packaging, trying to get increased interest in their funds. And, quite frankly, I personally, my own opinion only, I think it's going in the wrong direction. So how does Defiance IWMY generate cash? Well, the daily credit call spreads. First is the exposure. They're doing 100% Russell 2000 tracking. Okay. So what they're doing here is they're tracking the index of the Russell 2000. Okay. And that's what's giving them their engine for their base run. They're on top of that, they're overlaying call options. So what they do is daily credit call spreads. It sells daily options to capture the rapid time decay. So what does that mean? Does it mean we're paying out daily? No. What we're meaning is we're setting every morning, we're resetting our credit spreads, our call options of where we want them to be. So I'm going to put it to you real simple. At the beginning, Monday morning, 9 o'clock, we all agree that we're going to sell our index today, and I'm making numbers up, is $100. Okay? That's what they're going out for. Plus, what they're going to do is buy higher stake call, which is what we call protection. So they may come up and say, hey, let's buy one at 105, or let's say we're going to buy one at 110. So what happens if they'll sell their 100, but they're still in the game at 105. So they still are gaining the growth coming out of a particular market. So the net premium for distributions is coming from multiple places, from selling of their call options, buying the additionals, capturing the upswing, which again will capture more premium. So this is what they call the spread structure, provides some upside after a significant index move. So if this thing's moving in the day, they're going to capture that. The results is a weekly payout and the risks. Short expirations allow for frequent cash flow generation, reducing the gains during moderate rallies due to the short leg, and small premium cushion in declines. So the positive of this is if you have a big volatility, you have a big jump in the pay, you're going to collect a ton of money out of this one because they're constantly collecting the higher step on the rung of that ladder. But when you get a moderate rallies, things are slowing down, you're not going to gather as much income across the board. Now let's take a look at how NEOS, IWMI, this is where I always told you guys are going to get confused with the I versus the Y. But NEOS, at a glance, it's a larger, lower cost monthly income. Now this one has a $1.09 billion in assets. The net asset is 0.68% expense ratio. So right in line with where where it's been, and they capped it all the way through May of 2027. It's a monthly distribution. And now what they're asking for, we always say the bid risk spread, is they're looking right around about a 0.04% spread on most of the calls that they're doing. Now this one here, this launched in June 24, 2024. It's established track record in the Russell 2000. And I say that for a reason, because we got one company who just changed their strategy going into 2026, and another one's been continuing it since 2024. Okay, they actually reduced their expense ratio from 0.76 down to 0.68. Now, this could be, and I'll be honest, is talking with them, I did not get a full read of it, but they reduced it to stay in marketplace, and the question is, will they continue staying at that point? So they are really tight with their liquidity across the board. Now, the operation, it's designed for retirement investors. That was the first thing I enjoyed when I saw that, is it's really designed for retirement to give you that monthly cash flow. It targets more of a moderate, sustainable income stream compared to the weekly strategy. So this whole thing is built for retirees to generate cash flow. Now, how do they generate that cash flow? Well, they do two allocations. Now, what they do is the Bedrock investment provides a direct exposure to basically the Russell 2000 small cap companies. Now, this is an institutional grade liquidity and a low underlying expense ratio. It captures the broad market of the Russell 2000 index. Okay, they're covering, and I know people are going to come back and say different things, but about 99.6% of their portfolio is covered through call spreads. Now, sometimes they'll back it down. Okay, this is why you'll see people say, we never cover 100%. You're right. You're 0.004 of not covering. So this is what they do. They try to always keep the goal out there of getting calls. The call spread, they sell what we call RUT, R-U-T, call options against the underlying small cap exposure to generate premium. The optimistic, they buy out of the money calls to preserve that additional upside, similar to what we just talked about with Defiance. And it targets a moderate income stream, about 14%, to avoid excess NAV erosion. Okay, so the very similar structures now between the two, one doing weekly, one doing monthly, always doing that ladder of selling selling their call options and getting prepared to try to buy out of the money packages. So we get to the headline, which is what we started off with, and now we get to the hardcore comparisons. So IWMY from Defiance advertised that they were targeting a 30% annual cash target, paid out weekly. Okay. Now, right off the bat, the first thing you look at is the 30-day SEC yield. It's negative 0.85%. That means their 30% that they're getting is come from pure premiums, selling those options, because the money that they have invested is not collecting the interest. They're not doing anything to generate dividends, interest, or anything like that. It's all sitting in getting those premiums from their option calls. So their targeting monthly NAV target is 2.5%. Now, I put a 42.07% because at the time of doing this video, the numbers came across to me that they were able to achieve a dividend yield of 42.07%. This is over the past 12 months. Now, I know that's going to have some of their other strategy into it, and I told you I wasn't going to do that, but I wanted to clarify because I always get people commenting. But this is also 42.07% comes to you because, well, the price of the fund. The price of the fund's been down. So it's really fluctuating. That's why I always want to show you is that the price goes down, this yield number is going to go up because the price has dropped off. Now, IWMI, the NEOS, holds in about 14.42%, paying monthly They have a 0.50% 30-day yield. That means they are actually collecting some interest. They are collecting some, if it's dividends or however other money other than their call options. So that means their trailing past 12 months was 13.59% of coming directly from those premium calls. So on the surface, we start off with $100,000 invested. You're going to get $30,000 on your weeklies. I'm only going to get $14,420 off of my monthlies. So right off the bat, you're saying, man, I'm making more and more money. Now we talk growth. This is where NAV starts coming into play. Okay. So when we sit down and say, how are these guys done against the index? So the year to date, which was really important to me, is to give you the apple for apple comparison. Year to date, the Russell 2000 index is up 22.57%. NEOS has been able to capture 18.21% of that growth, which is not uncommon. They're as long as they're close, because they're doing the call options. Russell's not going to generate income. You're getting income from the NEOS package. But look what Defiance did, 15.75%. So they're basically just shy of 2.5 percentage points less than what NEOS is doing, and dramatically less than what the index is doing. When we take a look at the total year, well, it comes right back to the same thing. Russell's up 40%, IWMI, the NEOS, is up 36%, and IWMY is up 22%. So you can see that they're only capturing a smaller portion of the rally, of the growth of what the Russell 2000 is. So we're giving up some growth to get income. Well, with the weekly one from Defiance, you're giving up 54%, you're giving up, it blew my mind there, 46% upswing. You're only getting 54% of the gain. Now let's talk about total returns, because guys, bottom line, this number tells you everything. It's not about income. It's not about growth. It's a combination of everything together. So when we take a look at total growth right now, I put this into the 1 year mark. So this is going back one full year. And I'm going to be able to break down here and show you where we sit with the year to date comparison. Now, both of these lines are going to also almost match each other as the way the indexes are going. But when we look at one total year, you got 39.31% total return as of the filming of this versus 17.23%. Now, I'm telling you right now, over 12 months, I told you 14% was from NEOS yield. 14% from 29, you're going to get a bigger number. When you take 30% from Defiance from 17.23, you're actually losing growth. You've lost money. Let me break it down this way for you. This gives you the 1 month, year to date, 1 year, and since inception. It's giving you apple for apple comparisons. And this is why I do this, is because I just want to be apple for apple. But NEOS has shown you that 14.42% yield. That gives them about 11.88% growth for a total return right around 26.30%. Now, if you tie in reinvesting your dividends, this is where you're going to pick up that 28.91%. Now, Defiance, advertising and promoting the 30, and at this time I did this, was 36.78% yield, but their growth was down 19.89%. So that your total return comes in at 16.89% because really there was no yield dollars to reinvest. That's why you see it matches accordingly. So when someone sits there and tells me that we're getting 30% on Defiance, I love it. I immediately go to total return and say, but you're not keeping the money. The money's not staying in your pocket. Okay, you're giving it away day in, day out because you have that NAV loss to it. So the big difference between these two, and I say this is, you can talk 30%, you can talk 14%. I'll take 14% over a 36% yield all day long when my total return numbers are showing me that my total return is bigger than the yield, not smaller. That means I'm getting growth, not losing, and I have a win-win situation. Now let's talk about the NAV and the return of capital of the room. More than likely, basically talking to you as cash, or this is tax side of things. So IWMI Defiance, as we said, they're shooting for that targeted program. 86.15% from July 24th has been recorded as ROC, return of capital. That is their tax harvesting thing. ROC, as we've done many videos on, I've talked to you many things about, you know ROC reduces your costs. But if you do it right, it's okay. It's an advantage. If you do it wrong, you're literally taking people's money and handing it back to them. So they're saying 86.15% is this. That means because the higher payout target of 2.5 NAV is its increased risk of capital erosion. Means they probably have returned some of your own money back to you. So the thing bounces around. Now, none of these numbers mean anything until you get your 1099 DIV form. Remember this. But this is where you always want to track, and this is why long-term history will tell you exactly what's going on. So the big scare with the Defiance is distributions exceeding the economic profit, reducing the NAV and the trading price. And when you start going NAV erosion, you are going to have a hard time cleaning back. And we've already seen they're not capturing the growth. They're not capturing the upswing of the Russell 2000. While NEOS has a complete different package on their programs as we go through. One, for taxes, they use the 1256 contracts, which means part of their distributions are going to be long-term capital gains. The other side is they do use ROC. They also do tax harvesting. They do a lot of different things in the tax side that we've covered many, many times. So even so, they both use the ROC. They both have a common 86% playing around with that. But the tax advantage, hands down, goes to the NEOS family. And breaking it down even more, IWMY, ordinary income potential, okay, even as they use ordinary income, some qualified dividends, and the ROC, their high portfolio turnover, approximately 71% of their portfolio has turned over. That's very short-term application. So not using 1256 contracts makes for a huge difference. That's why you see a lot of capital gain. You're going to see some ordinary income, and they have to use a high ROC to maintain it. So the qualified dividend outlook, the prospectus notes that qualified dividend income is unlikely to be significant. That's why I say this whole thing is going to give you ROC and then ordinary. So on tax side, Defiance does not have their things together. Now, IWMI is the major tax advantage, as I told you. I put all three up here, the Section 1256, the tax loss harvesting, and the deferred ROC strategy. So in taxes, you're going to keep more of your money inside the IWMI. Now, if you're putting these all into a Roth IRA or a standard 401k IRA, then you know what? This portion probably doesn't relate a lot to what's going on. But somewhere down the line, you're going to open up a brokerage account, you're going to pull money from a brokerage account. These are going to be critical pieces. So the risk, neither one, I'm going to tell you right now, is a safety bucket. Don't ever read it wrong, because when you're doing call options, you're going to have risk. But the Defiance program is very highly complex. It is that daily volatility. It sounds like a great plan, but it takes a lot of risk to guess and gamble what's going to happen in the marketplaces. They have a very high target for the cash. They put that huge target out there that they got to achieve 30% to make it look good. It's just a lot of smoke and mirrors trying to get you into the program. So there's a ton of risk over there. And there's also risk in the NEOS program. The covered call, as I tell you, limitations, the cash flow and the caps that get involved into it, the premium sensitivity. If we're looking for this thing to grow because we're selling calls, we're looking for it to grow. If we have a downtrend, you're not going to get the income coming out of it. So there's a big gamble between both of these, but we all have risks. It's kind of why we're getting income. We have risk versus reward. So my scorecard for retirement, yep, the high 30% distribution sounds great from Defiance. So we got to give them the check mark there. The growth, they're capturing 81% of the growth of the Russell 2000. Very pleased with that side. Total return, it's got to go to NEOS across the board. Tax advantages, NEOS with the 1256, harvesting, ROC across the board. The expenses, you're going to hold this for long periods of time. Do you want to pay 1% to this? And if you have a financial advisor, he's collecting another 1%, you're going to only pay 0.68% on NEOS, and they reduced theirs down till March of 2027. When you get the fund sizes, well, 1 billion always beats 100 million. No doubt about it. Now, payment frequency, I put it over to weekly. I know weekly sounds great. Weekly, when I first saw weeklies, I was excited. I jumped on them as well as everyone else. But I'm finding out definitely we're into only monthlies can survive. You just got to do some budgeting while weeklies make people exciting. So realistically here, we got 5 wins for NEOS, 2 wins for Defiance. I think it's going to be very clear what we talk about. So the retirement portfolio role, core income versus high risk satellite. I think IWMI is a diversified income source. It's a balanced small cap exposure. I believe this is another sector in a retirement income bucket you want to use. It's a diversified bucket. It's got NAV. It's holding its NAV with that lower targeting. It's got tax efficiencies. And the role for this thing is that income, small cap income. So you have your S&P 500, you got your NASDAQ 100, and now you have a Russell. So I would put this in my income bucket. Now, I know we put this as a high risk satellite. This is an aggressive kicker. Defiance as an aggressive kicker. I can only say satellite, realistically, only positioning for this. It's not a vehicle to build long term onto. The strategy is all brand new, so we're learning that one. The NAV is got a huge warning to it, continuously dropping. So honestly, my true opinion, the only way this thing classifies in any area would be in a satellite position. But my final verdict across the board, I have no problem putting the NEOS package as a core piece in my income bucket under the Russell 2000 category, which is probably only maybe 10% of my total income bucket is into the Russell 2000. I just don't like the whole big gamble of Russell. I'd like putting more into the S&P 500 with a better exposure, but I'm not saying this is wrong, but it gives me a whole nother leg to work off of. And NEOS gives such better things, a better capture of that growth, of the gains, generating income across the board, better tax efficiency, lower handling costs across the board. My strategic plan in the IWMI, the Defiance 2000, I know I told you, a high risk satellite only. I don't even suggest this for anybody to put into a retirement package. Even in a satellite thing, it's too risky. It's way too far out there, and it's not performing what you think. If you have the same apple for apple, forget weekly, forget 30%, forget all of that. Take 2 funds, put them down to each other. A common person would say NEOS over Defiance each and every day. Guys, let me know what you think. Leave a comment down below how you feel about these. Hit the like button, helps us on the best. And most of all, don't forget about our supporting the channel. I got a lot of different things. We got license plates, we got coffee mugs, we got travel mugs. Hit the link down below. It'll take you to the page to see everything. Everything helps support the channel so we don't have to have advertisers or so on. I appreciate your time. Thank you. We'll see you next time.